Hello, everybody. So let's quickly talk about HIMS today. The Q1 call tomorrow, Q1 earnings tomorrow, the short squeeze potential, what I expect. But let me just begin by saying that, of course, Wall Street doesn't get HIMS. And traditional healthcare also doesn't get HIMS. And it puts HIMS into this specific situation where it is so cheap, so dismissed by the market, and where you have so much of traditional finance essentially shorting the name. And it has a hard time. Traditional finance has a hard time. The competitors of HIMS have a hard time envisioning a company with a quirky name, right? HIMS, that's a funny name. It has a hard time envisioning this company simply replacing the cash cow vertical of healthcare, and that's why the shorts are so high. I believe HIMS could potentially take so much business away from traditional healthcare. And I've said that multiple times in my videos on HIMS. And the question is, how did IBM, say, for example, feel about a company named after a fruit? How did Barnes & Noble feel about a company named after a rainforest? How did the entire worldwide linear TV complex, the entire TV complex, feel about a company called Netflix, right? Internet movies. And so how does the current 21st century world of healthcare and finance feel about a company named HIMS? HIMS, what is this? An ED company? Is this a company to try to teach you how to spell? What is HIMS? What does HIMS stand for? They entirely dismiss it. They don't do any deep research on the stock. That is what I fundamentally believe it. They just dismiss it. And the 21st century companies, the S&P 500, they're all full of bloated, overstaffed, overly hierarchical companies who never see it coming, who dismiss innovation. And HIMS, make no mistake, is a very highly innovative firm that is misunderstood by two industries, healthcare and finance. Hence the shorts, and hence why this company is so cheap. Because yes, the valuation at HIMS is still absurd. Absurd is the right term for that. Because, of course, we may be upset because the stock went up. I didn't put the stock chart, right? But we're back above $40 and we sat below $30 for like 2 or 3 weeks. And so we may be upset that we missed out when the stock is trading at 40. We may feel we missed out, right? But it's important to remember that in my spreadsheet, where I still use 62%, by the way, I should update that to the upside big time. I'm waiting for Q1 to update that number, because when I put that 62 number for revenue growth number, I was assuming that the commercial GLP-1 business was going away and that we could only sell liraglutide, right? So I have to update that number. The inflection point we saw in the sales for HIMS might very well be durable, at least for a future year or the next 2 years. So I need to update that. But even without updating that, keeping the same number, I get enterprise value over gross profit over revenue growth of a 0.12 and a rule of 40 of 75, the rule of 40. So very high. And of course, HIMS is my favorite of the cheapest stock. Out of its cheapest stocks that I follow on the channel, high growth, low valuation. That's one of my buckets of investing. Super high growth companies, super low valuation. If I compare them to other stocks that I like a lot, like Supermicro, like ELF, like Celsius, the valuation of HIMS doesn't even come close. Like if I were to say which pick, if I put HIMS in a match, HIMS in a duel, HIMS against SMCI, HIMS against Health, HIMS against Celsius, HIMS against just about every single stock in the spreadsheet, I prefer HIMS. I prefer HIMS against just about every single stock in the spreadsheet. Taking in mind that, of course, MicroStrategy and Tesla are not in that spreadsheet. They are not to be rated by that spreadsheet. Palantir should not be rated like that, right? Some stocks should be rated differently. But out of stocks that fit for my enterprise value over gross profit over revenue growth, HIMS always comes on top. And it comes on top not on valuation, not only just on valuation, but also on quality, right? There are stocks that are cheaper than HIMS, like LifeMD. For example, LifeMD, I think, is the better discount now. Now that we're back above 40 for HIMS, I think LifeMD is the better discount. But LifeMD is not the quality of HIMS just yet. LifeMD has not executed nicely over and over and over again like HIMS, right? HIMS is a higher quality company like LifeMD, even though LifeMD is slightly cheaper. I have BioStem that is cheaper than both of them, right? Out of 200 stock, BioStem is the cheapest stock, but BioStem has a flurry of risks, so many risks, which are made acceptable by the fact that it's trading 12 times cheaper than HIMSS. But still, if I'm looking for both quality and cheap, I can't find a stock that is both so cheap and so high quality besides HIMSS, and this is despite the stock trading now back above 40 after spending a few weeks under $30. So the big news, of course, and this is going to be the Q1 topic. I fear we're just going to keep talking only about that in the Q1 call, because that's, Wall Street cares about the next quarter. They care about the next 3 quarters. I wish they would talk about menopause. I wish they would talk about hormone replacement therapy. I wish they would talk about, I don't know, maybe a HIMSS physical. Maybe you pay $9.95 a month and HIMSS does your yearly physical. Maybe your urgent care business. There's so many highly profitable verticals that HIMSS can add to the business model, but that's not what Wall Street's going to be focusing on. Wall Street is only going to be focusing on GLP-1s, on weight loss. Of course, this is the last time I get to say that the weight loss business is only 15% of HIMSS revenue. The weight loss business will be a much bigger share of HIMSS revenue tomorrow after a report. So let me just say that once again. The HIMSS revenue right now is only 15%. It's going to go way up. And the question is, are we going to go back to the pre-GLP-1 growth trajectory of growing at a cozy 55 to 65%? Or are we going to stick to that post-GLP-1 trajectory now that we have a commercial offering? Are we going to keep growing for this year at, say, 90% or 85%? Right? This is going to be a big question on the call. Are we going to break the 50% telehealth market share mark? Are we going to break that? That's going to be a big question on the call. Guidance should be huge. You may remember in the early days, they had guided for $1.2 billion by 2026. I used to laugh at that guidance, right? Perhaps Andrew Dodom is the sandbag king, the sandbagging king, only second to Saylor, because Saylor is even more of a sandbagger than Dodom. But Dodom has set up the guidance for success over and over again. So I have all of my reasons to believe that the guidance is once again set up for success, i.e. he's going to raise the guidance. That's what I think. And the execution is stellar. The execution is stunning. They're pushing these ads on Wegovy all over the internet. You've seen them. I've seen them. I showed you this. This is an email that he had sent me, but that's just one of many, many ads. They're on all of the social medias. They're on the Instagrams of the world, the Facebooks of the world, the YouTubers of the world. They are everywhere. I saw them actually push also an ED drug on YouTube recently. Very interesting. Anyways, the point is, how will I play HIMSS? How will I play HIMSS? Volatility is vitality. This is how I hope to play HIMSS tomorrow, and I'll let you know if I end up doing it or not on the Patreon, of course. How will I play HIMSS? Well, there's enormous float. There is enormous shares that are floated short, that are short. That's what I meant to say. There's an enormous contingent of short. We don't know how many shorts there are. We don't know. And of course, the spike from Friday, right? The spike from Friday is because the shorts were covering, because we went up 12% on Friday. That was insane. The shorts were likely covering quite a bit. Did they cover enough, right? That's the big question. Did they cover enough? I think we're going to get to find that out this week when they re-release the new numbers on the shorts. Will they have to cover much more tomorrow? And that's why I think the sentiment, at least in the HIMSS community, the big sentiment is that we're going to get a major spike tomorrow at the stock price. And by that, I mean a spike to the upside. Unfortunately, a spike to the upside is what the market participants seem to think. As you know, on this channel, I don't do any short-term predictions on the channel. I don't do any short-term prediction, but this is how I think I'm going to play it. So why not just harness volatility and sell puts prior to the earnings while harnessing volatility? At this point, I would dream to get back into HIMSS, to add back to HIMSS at $30. I would dream to add to my HIMSS position at $30, right? This dream is far away because HIMSS is trading right now at $41, right? I want to add at 30. So why wouldn't I sell a put? I can sell a put, sell a cash secured put, right, for May 9th, right, at $30 strike, and look at the implied volatility on that thing. 204. This is, and of course, why is the implied volatility so high, right? Because the earnings are this week. That's why the volatility is so high. And conventional wisdom says you should never write puts during high earnings volatility. But in this case, in this case, I think it's very valuable because I want to buy it at 30. I'm interested in buying it at 30, and I'm gonna be sad because I don't think that's gonna happen. So I'm gonna be sad tomorrow, but maybe I'm gonna be less sad if I can just sell a put and collect $37 on $3,000 of cash secured, right? So that's about a 1.2% yield. That's about a 70% annualized yield. You can see the Black-Scholes formula tells you the odds are almost 90% odds of this not happening, but the Black-Scholes formula doesn't work. This is well known and very famous. But anyways, the point is, to quote Buffett, and this may seem like collecting pennies, right? But to quote Buffett, pennies are the beginning of the next $1 billion. And so maybe I dampen my sadness a little bit by writing some cash secured puts on the $30 tomorrow morning when the volatility is so high at 200%. And again, if for some reason or another, something goes on, the shorts are all gone or something or whatever, expectations are too high, and if for some reason the stock drops 20-25% yesterday and I get a sign, then I will be the happiest guy out there because I'll be very pleased because I want to add back at 30. And of course, if you're feeling lucky, the near the money puts, the puts at the $40 put pay more than 10% for 5 days. So you're at well over 500% annualized. But that's if you're feeling lucky. And I call this much closer to gambling, right? I'm not interested in doing that. I'm a long-term investor. Collecting pennies on this, could dampen the blow a little bit, and maybe I take that money and put it in LifeMD because if the stock, if HIMS runs towards 50 tomorrow, for example, I'm definitely more interested in LifeMD when HIMS is at 41 or $50, right? If HIMS is under 30, I'm interested in HIMS. So that's how I'm planning on playing it. Anyways, this was not investment advice, not financial advice, just entertainment or being you were entertained. Please please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.